Okay, it is 12:02, so we're going to start the webinar now. Again, if please let us know who you are and where you're from and type in the chat, and I will hand it off to Ellen to kick us off.
Hi, everyone. Welcome. Yeah, start adding your name and organization just in the chat so we can know who you are. Very excited to have everyone here. It's been a session that we've been intending to host for a long time. Many of you have raised, hopefully, or are looking to raise money. And how do you think about investors, who's investing in you? How do you diligence them? So we have two veterans who have experience in this realm. We have Teresa Spangler, who has raised money and currently has her own company supporting many founders out there. And then Mike Kijewski, who I know he's with me here in San Diego. I'm in San Diego, who's on his Series B and growing, but has scaled a couple of companies. So very, veteran at picking and choosing and working with investors. It's a long-term relationship, so have to be careful. Well, with that, I'm going to have each person, each panelist introduce themselves so that you have more context on what they bring. And then while we're doing that, as questions pop in your head, please don't be shy. Stick them in the Q&A so we can track. The Q&A section helps us track whether or not we've answered it or not. Thank you so much. So Mike, why don't you give us your background and what you're doing today with MedCrypt?
Sure. Hey, everybody. Great to meet you. My name is Mike Kijewski. I'm the co-founder at MedCrypt. We are a medical device cybersecurity company based in San Diego, California. My personal background is in medical physics, which is the science behind radiation oncology and diagnostic imaging. As Ellen referenced, I had started a small healthcare IT company while I was a graduate student in medical physics in Philadelphia. Ended up selling that company to a medical device manufacturer. Worked there for a couple of years when I saw that there was an opportunity to help people who build medical devices, things like pacemakers or CT scanners, build cybersecurity features into those products. So I was doing the math here earlier. Never thought of myself as a veteran, but I think I've raised 8 rounds of funding at this point. Every single one of them took a year off of my life. And I'm happy to hopefully help those of you on the call avoid some of the mistakes that I made.
Yeah, thank you so much. And Teresa.
Yeah, my name is Teresa Spangler. I'm CEO of Plaza Bridge Group, which we're an innovation development company. I have also raised money and for a technology company many years ago. And my dearest friend is one of the lead investors that invested in that company, which I will say was not an easy thing, especially for a woman back in those days. But I've helped a lot of companies in spinning out and commercializing technologies, both in military, university, and just founders with ideas, trying to help them navigate those instances of raising money and actually growing a company. I was also part of the IPO team at Red Hat, hired on very early, and it was a significant experience that in terms of, because when I joined, we were also raising money. So it was a lot of things that maybe I can help bring to the table. And I agree, Ellen, they will be in your life for a long time. So you want to know the ones and agree that they're aligned with you whenever. That's my kickoff feedback.
Thank you. Well, maybe I'll start with you then. How can you tell if they're aligned? Like what's that maybe, what are the phases one goes through as one goes and talks to investors?
Well, and I think you want to be ready when you're talking to investors. You can, in some cases, talk to investors a little too early. When I was raising money, the investor that I networked with before had the startup, and just to get to know them. And so I did put some energy in, but I wasn't trying to pitch or present any startup. I wanted to know the investors. And in that case, they got to know me and also got to know, I built a confidence in me. I think that's one way to do it. But when you're ready to present, if you can have those relationships, it can help you, I think, a great deal. If you present a little too early, you're going to get feedback, and they may make some assumptions. This is my experience. Mike's might be a little different. Sometimes they make assumptions and they sort of pass for good, and it's hard to come back. because if you've got some milestones and you can show once you've started that you're hitting these milestones and you can build the confidence that you're doing what you say you're going to do, then you get more allegiance on their side. What you want to know, though, is how does it feel? I mean, are these, have you looked at where else they've invested? How do the portfolio companies align with what you do? They may take a board seat, so you want to be comfortable. You could talk to some of the other founders and get to know their investors and how, how they feel about them. And sometimes the other founders will make introductions for you if you kind of know what you want. But I always like to say, identify the best type of investor. In my case, it was a mentor, strong relationship, someone that introduced and helped and was very much a guiding force, not just a board member to tell you what to do. And that was really important in those early days and when we were starting up. So I won't say it's easy. I will say it does take a lot of diligent work.
Thank you for that. I second in the fact that you can start talking to and potential investors. Maybe you're just at networking events that pertain to startups.
Yeah.
To then get to know each other. And then you can start asking around, because I think there's a referral network within different clusters of companies, right? In certain domains, and you can get the reputation, potentially understand the reputation that way.
Yes.
Mike, how was your experience, similar or different? And how do you think? What's your framework since you've raised 8 rounds? Like how did your experience change?
Yeah, so out of those 8 rounds, I'd say there were 3 of them where our company was raising money and we were not in a great position, right? We didn't have as much leverage as maybe we would have liked. And it's a very uncomfortable position to be in because, we had a business, we had 4 months of cash in the bank, and we needed to take money from investors, and we got to the end of a process. We had a certain set of investors to choose from, and it didn't really feel like not taking money from them was an option, right? So we were at risk of maybe making some bad decisions. Yeah. And I think that if you find yourself in that situation early on in the life of a company, it can kill the company, right? If you get a bad investor on your board as part of your pre-seed round or something, that's just it's 10 years of just banging your head against the wall. So that can be really tough. But fortunately, in each case where we raised money, we were either able to optimize for taking money from people who felt like good partners, or got lucky. And we haven't had too many issues with investors that weren't good partners. But I have, either friends who've started companies that had some bad investors on their board, or heard, secondhand about people who can be in rough situations. And there are a lot of basically bad actors that are out there looking to take advantage of founders with good ideas who are trying to raise money. And it's a really difficult balance.
Give us some examples, like what are some specifics without naming names?
Yeah, so there's a pseudo competitor in our space that exited very early on in the life of the business. And I thought it was a very promising company. When they were acquired, I thought, it must be for billions of dollars. And it turned out that they sold for basically the amount of money that had been raised in the company, which generally means the founders of the company have very little, if any, proceeds from the sale of the business. And I found out 6 months later that essentially one of the board members decided they didn't like the CEO's approach to running the business, and they were going to replace the CEO. And the CEO really only had 2 choices. One was stop working at the company that he had founded. And the second was arranged a sale that he was able to convince enough board members to vote for. And now he, works at some big company, probably not having as much fun as he would be if you were running that company from the beginning. So that's the kind of the classic example of you get an investor who wants to take too much ownership in the business, makes big decisions for you. The other is just the cap table, which is the list of investors in your business and how much each person owns. I think a lot of times founders feel like they want to maintain as much ownership in the business as they possibly can. And investors a lot of times feel like they want to take as much ownership in the business as they possibly can. But in reality, there's sort of a healthy evolution of a cap table where after each round of funding, ideally you're not selling more than 15 to 25% of the business. And if your business gets to some sort of scale, right, we're a Series B company, we probably have 2 more rounds of funding to raise before we get to the point where we don't need to raise money from venture investors anymore. The founders need to own some meaningful portion of the company, or else they're not properly incentivized. And if you have one investor who owns 40% of the business, that's really problematic too, because if they disagree with you, you're kind of stuck. So finding investors who really are partners and who are able to say, hey, there's a range of reasonable valuations here. There's such a thing as too low a valuation and too high a valuation. Is really something you want to look for early on.
Yeah, it means talking to lots of folks. I often work with companies that way, and especially as you're raising, don't give away more than a third at a time, et cetera, those types of things. So Teresa, do you have anything to add from your perspective, kind of crazy investors that you might have known?
Yeah, I've seen a lot of them. Sometimes the motivation is not as honorable as you want it to be. And so I think, like Mike said, I was in a situation where the investor actually invested because they wanted to be the CEO. And so it's interesting that if you can sort of gauge the motivation of why are they investing in you, what's their core interest, and are they there to help you grow as a CEO if you want to lead that company. So I've seen that. I've also seen, the board of directors, because sometimes if you take in too much money and things are not hitting the milestones as you sort of agree to, or the revenue stipulations, or the product getting it out the door, then there's always challenges. If you're having to go take more money, you're giving up more equity, or they start to look at replacing people again. And so I think it's not to scare anybody, because there's really great situations that you can raise money and have a really healthy relationship, but you want to ask a lot of questions. I think due diligence on the investor side, that team of investments, there's a lead investor, and that lead investor is very much going to be helpful in bringing the other investors to the table. Typically, they're going to want to bring people that have invested with them before a lot of times. So, it's a lot of work for the lead investor, but every investment, except for, I would say, if you're going after a seed round or an angel round, those might have different stipulations. But if you're starting to get some bigger investments, you're going to have someone needs to lead it. And that's the person or the group that's doing a lot of the work behind the scenes to make this all documented and working. I do think too, there are a lot of new investors popping up, a lot of people saying that they are investors. And it's, again, they may be young investors or maybe young investment groups. They don't always invest. And I think you really want to do the due diligence. Have they invested? How much have they invested? What has been their success rate with their portfolio companies? Because I think there's just a lot of people saying they're investors just to talk to companies that are starting up. And it certainly, could be good partnership, but it might not be a good investment partnership.
Yeah, I think it's okay to ask those questions. I have my own investment syndicate. I get asked those questions. I very easily can answer those questions. When I didn't have an investment under my belt, I said I didn't have an investment under my belt.
Yeah, I think that happens a lot. Yeah,
but
that's okay.
It's okay. You got to say it though. But at least so you have, at least investors can also be startups, right? There's a lot of startup firms, and so they have to, they do the same thing. So going back to Mike, some folks are asking, how did you get your first investor? How do you position? Is it angel investor different than a venture round? Perhaps give us the landscape there.
Yeah, it's very, very different. And as we're talking about how important it is to diligence investors, I'm imagining a younger version of myself on this call. Like, I can't imagine having multiple investors to choose from. Like, please help me get 2 investors that I can diligence the 2 of them. I'm having a hard time getting anybody to give me money. But I think in both of the companies that I've started for which I've raised money, the first check was written by somebody who really, it's cliche, but was investing in me, not the business. And it came not as the result of me asking for money, but asking for advice, right? There's the saying, ask for advice, get money, ask for money, get advice. And it's really been true in my experience. The first company that I started was a healthcare IT company that was basically doing CAD software, but for hospitals. And I was a graduate student at the time. and there was an alumnus of our school coming to speak on campus, and he had been the co-founder of a CAD company that was now the #2 largest CAD company in the world. And I deduced his email address, sent him an email, said, hey, I'm a student working on this CAD startup. I'd love to tell you about what I'm building and see what you think, if you have any advice. Met with the guy at had breakfast with him before the on-campus event. He invited me to their office, which is about an hour away. And at the end of that meeting, he said, hey, are you raising money? And I said, I don't know, I guess so. And they ended up writing me a check for like $125,000 the next time we met. And I wasn't even running a process. I suspect had I emailed him and said, hey, I'm raising money for the startup, can I meet with you? He wouldn't have taken my email, right? And he ended up investing in our company twice. We exited the business, wrote him a nice check. That felt really good. And then the company that I'm working on now, MedCrypt, our product is similar to like Internet of Things software, IoT software. And it just so happens that I was friendly with the co-founder of an IoT company called ThingWorks that had been acquired a handful of years prior. This guy took money from an investment firm that I happened to know through my school connection. And we've become friendly over the years, and I talked to him about his experience at ThingWorks. And when we were raising money for MedCrypt, I called him and said, hey, here's our idea. Does this sound plausible? And he said, yeah, if it is, it does sound plausible. And if you're raising money, my co-founders and I from ThingWorks would like to invest. And they wrote the first $75,000 into MedCrypt. So in my experience, the first investors in our companies have been, number one, people who had some personal interest in my success above and beyond the business itself, but also people who had professional experience in the area that I was working. So let's say, fast forward, hopefully not too far in the future, and I'm a wildly successful entrepreneur and I have money to write angel checks. If somebody comes to me with a satellite company, I'm probably going to say, hey, that sounds really cool. I don't know anything about satellites. But if somebody comes to me with a medical device software company, I'm going to feel much more able to provide value. So look for people who have personally been successful in an area adjacent to the area in which you are working.
Or the domain area of their investments are in that domain area that you're working, because I think that's a really key point. If they don't understand it, then you're trying to educate, and it's really hard. Most likely, they aren't going to be comfortable investing. And Ellen, I wanted to bring up, I think even in my first investment, in my first venture, we did a lot of the angel groups, a lot of them, angel groups that you would present to the group, and we'd walk out and the group would say no as a group. But then, like Mike, we'd get a call from one or two of the investors inside who personally wanted to. So if you get a no from a group of angels when you're presenting to the group, don't hesitate to reach out to individuals and find out what their thoughts are, because they may have an interest.
Yeah, absolutely. In fact, that might be, some folks are asking about where to source investors. The saying is, look at friends who have raised before. If you're in areas that don't have a lot of that, usually most areas have some sort of angel group, and their reputation probably is they don't invest.
Typically.
But you can still do what Teresa said, is go present, or at least understand who's on that area. I mean, that's actually a personal passion project of mine. How do we actually mobilize more investors and teach them how to invest, not just generically, but in certain domains? Like you'll see, just for Mike and Teresa's knowledge on here, there's several folks who are in the space sector, and it's a niche sector. And it's always hard to raise for a space company, but there's an increasing number of VC firms as well as investors that look at seeding investment in this domain.
Yep.
I guess going back to Mike, going back to you, thinking through, how did you diligence the investors?
Yeah, so I think my favorite question to ask when I got to the point where I thought I wanted to work with somebody was, can I talk to a handful of your portfolio companies, and they make an introduction to the CEOs of those portfolio companies. And if the feedback from the founders of those companies is anything less than glowing, I take it as a 0. It's a 1 or a 5. They're either giving the founder a 5 or a 1. And you can pretty quickly read through the, between the lines. Is this person taking the call because they feel like they have to, or are they genuinely enthusiastic about the investor? But once I'm talking to one of those founders, I generally would ask, can you tell me about a time where something wasn't going well and how this investor reacted? we had a situation 2 years ago where our company, we were in a very, very tight situation. And I was calling all of our investors and board members and saying, hey, we've got this very promising thing, but our cash doesn't get us there. What do we do to fill the gap? And one of our investors, their answer was just, that sounds tough, like good luck with that, when they had the ability to help. And another investor was like, no, I pounded the table during a board meeting, like, we are not going to let this tiny gap cause the company to go under. And I will remember the way those two investors reacted for the rest of my life and the rest of my career. And you really want somebody who, when the time gets tough, is willing to help. Now, maybe there's a time where the investor decides, okay, the business isn't working out, and you got to have a real conversation with founders. That happens. But in every company's existence, there's a time where something doesn't go right. Somebody quits, there's an HR issue, there's a lawsuit, there's some other angry investor. And you really want to work with investors who do not shy away from the situations and are the kind of investor that you want to call when there's a problem, not the kind of investor that you dread calling when there's a problem.
I think that's a really good point.
Anything else to add, Teresa?
Yeah, I just think it's, you'll have a sense when you're meeting them, and also, again, talking to some of their portfolio founders, and find networks in your community of founders that maybe you can talk to, so you get some experience from them. But I think it's that you're going to get a feeling. I mean, I know I do. I get a feeling if I'm uncomfortable with how they're going forward or talking about something, it's just that little innate intuition that says this isn't right for me. As soft as that sounds, it's real. And if you're not feeling comfortable in the beginning, you certainly aren't going to feel good as you're going through, because you're going to have challenges, and you want someone that will sit down at the table with you. I agree. Just talking to people around the community, talk to people that they have funded. Ask them hard questions. They're going to ask you hard questions, so ask them hard questions. If this doesn't go well, what are you going to do? How are we going to handle, something that isn't going the way that we thought it was going to go? And you need to be really upfront when you are invested in, to make sure you're telling them the bad news and the good news. And so they're going to want to know, that's what they're trying to get from you. Can they trust that you can sense and anticipate things not going well? Because if you can't, they're going to be worried, and that's not good. So you want to know that they want to know that you can do that, but you also want to know from them that they're going to be there if you come to the table.
Yeah, 100%. I was thinking about that. I think both of you probably are really good at keeping your investors aware. I'm most familiar with Mike because we're actually a part of Angel Group, is actually an investor in Mike's company, and he's one of the maybe few founders that actually keep us regularly updated, and that transparency really helps. Yes. It really brings other people forward, right? So just think about everybody online here, like, make sure you have that discipline. It's hard. It's so hard. You're doing all kinds of things. To do like a quarterly report is a pain in the butt, but you got to do it. And what are you afraid of? Because it actually starts to co-opt other folks coming in to be part of the whole movement.
Right. One other thought, Ellen, there's this idea that investors are pattern matchers, and that's actually problematic for a bunch of reasons. But generally what investors are doing is they're listening to your pitch and they're thinking, does this sound like a company that I know has been successful in the past? Does this seem like a founder that has been good to work with in the past? And that's fraught with issues, but it's to some degree the reality, at least today. But I think as a founder taking money from investors, you need to look at some pattern matching as well. At least in California, in the California startup world, there's a fairly rigid set of terms that are used during early investments into companies. A really common mechanism is something called convertible debt, a convertible note. And there's a version of this called a SAFE. And essentially what it says is, I'm going to invest in your company. I'm going to give you $1 million. And in return for that $1 million, you're either going to pay me interest or you're going to give me equity in the company. And the equity is going to be calculated this specific way. And there's really two terms that are put into the debt. One is what's called a discount, and one is called a cap. Right? The cap is the maximum valuation at which you invest. Generally, the discount is somewhere around 20%. And generally the cap is like, there's a range of reasonable caps for a, you're raising your first round of funding. The cap is probably somewhere more than $3 million and less than $12 million. I don't know, there's a wide range there, right? What you want to look for is, you get to the point where you're going to take money from an investor. Do they put anything in those terms that are out of the ordinary? Even small deviations saying like, hey, we want a 28% discount. I would want to know, okay, wait, why not 20 and why 28? Like, what is this, right? And there can be good explanations for some of these things, but you need to ask for what they are. And if you end up getting terms from an investor, that's what's called overly structured, where they say, hey, it's a convertible debt, but if this happens, then I get to do this. And if that happens, you get to do that. It's generally a signal that the person you're working with is not abiding by best practices. Teresa, has that been your experience?
Yeah, absolutely. I mean, and I think sometimes it's easy to overlook the term sheet when you're getting it to that detail, but if you don't, you're going to miss those things. So as you're doing your due diligence on the individual, you've got to do due diligence on the documents themselves before you sign anything. Totally agree.
Coming off of mute here, let's grab some questions from the Q&A. So I'm going to jump right into one from Jared Freeman. My question has to do with timing. I'm self-funded, but eventually need to raise capital. I've been putting it off until I have no choice, with the idea of retaining the most amount of equity. I'm concerned that might throttle my growth, but I'm risk averse. What should I do? Should I throttle my growth? He basically asked, what does the panel think of this strategy?
Well, I think one thing you want to think about is when you need it, it's not going to be there immediately. And so you really want to think in advance. It takes time. I think that's one of the things that people constantly overlook is it's not going to happen. It may not happen in 30 days, it may not happen in 60 days. And sometimes it might take 90 days to get the documentation done. And that's if you've got investors lined up. So, you really want to think in advance. If you've self-funded, I mean, investors like to see that you've put your own money or you have friends and family in, so that's kind of good. But I would get out and have those conversations. If you don't have a network that you've talked to of investors that know you and know what you're doing, you're starting from scratch. But go ahead and get started immediately if you think you're going to need that funding. It sounds like you're going to need funding to scale because you might not have it. And if there's no revenue coming in to help you with that scale, or you don't have sources you can create revenue, then I would definitely get out there and start talking now.
Yeah, I think there's a mathematical answer to that question, and then there's a more maybe realist answer to that question, right? Mathematically, I would model out the business and say, okay, if I took $2 million from an investor today, what does that do to my growth prospects?
Yeah.
Multiplied by the ownership I'll have in the company. And let's compare that to not raising money. What are the growth prospects for the business and how much will I own? And there are some cases where you're better off not raising money now. My business, MedCrypt, we're a tech company. We need to hire lots of software engineers. We need to build stuff that goes into pacemakers. It's fairly capital intensive. It wasn't really an option for us to bootstrap it, or at least we would have left a lot of opportunity on the table. Conversely, my wife and I are part owners in a camper van company with some friends of ours, and my wife runs the business. I would never raise money from investors for that business because my wife goes into work on a Monday, and if she wants to work on something, she does. And if she doesn't want to do it, she doesn't have to. There's no investors to report to. And I would never, that's not going to be $1 billion business. So I would never raise money from investors for that business. So it really depends on the nature of your business and what are your opportunity costs of not raising money.
Yeah.
So I was going to say, as one point to make there is that certain investors have a size of investment and a return that they're looking for, which is part of your due diligence before you even present to them. If they're looking for 10x or 100x, or they're looking for the $1 billion exit, I mean, you really want to know that because you may waste your time. So can you line up those that are looking for those niche opportunities or those segments that you might be in, which there are plenty, but just know who you're going after as your business lines up and aligns to what their interests are.
Yeah, lots of networking.
Yeah.
Here's a good one. Is there a glass door for investors?
A glass door.
Basically, is there
I'm not sure what that means, but I see that the blinds are always pulled. So if you're presenting and you walk out and you think you did a good job, you have no idea what they're thinking.
Basically, the rating system is
Yeah, they're
rating
sitting
system.
there and telling them that we're passing and you think you did a great job. You really don't get too comfortable after presenting. So if that's the glass door, it's like transparency and in how they're thinking. And some
Yeah.
will. I mean,
No,
some,
Glassdoor is a rating system for hiring. That's what they're trying to ask. I don't know.
okay. Oh, is there a glass? Got it. Okay.
So our company was fortunate enough to be part of Y Combinator. We were in the winter 2019 batch, and YC has a large enough community of startups that they have investor reviews, and they're very strict about not sharing the content of the investor reviews outside of Y Combinator. I'm sure there are other.
Do you still get access to those?
Oh yeah.
Investor reviews? All right, fascinating.
Call me later.
Oh, well, that's a good thing to do.
There's some gold in there. But I think for somebody who doesn't have access to that particular resource or one like it, your network really is the glass door, right? I mean, I would think if you spent some time in the tech world and you've done a little bit of networking, you shouldn't be farther than 2 degrees of separation from somebody who's writing a check and you check a reference, right? And I know that there are. I was very fortunate in that I was accepted through what could only have been a clerical error to a great university for grad school. And then through that university, I had a network where I can get to people by a degree of 2 or separation. What do you do if you don't have that network? It's unfortunate. I wish that these things were easier to access. But as an entrepreneur, you're going to have to navigate lots of cases where there's no clear answer. You're under-resourced. You don't really know who to talk to. So send 15 or 20 cold emails to people who are around that investor that you think you're going to work with, and ask if anybody will talk to you. And I'm pretty sure 1 or 2 will.
Yeah, got to be super resourceful. Yeah, there's been a couple of, I guess YC has something. I've heard of 1 or 2 sites that, at least in Silicon Valley, where they're rating VCs. Every once in a while they get shut down, I think, because investors have some sort of, they do have some power.
In the market where in the Research Triangle Park area, North Carolina, Raleigh, Durham, we have organizations like the Biotech Center, we have the Center for Entrepreneurial Development. The universities now have entrepreneurial programs. And so we would get together for conferences and forums, founders forums. And when we did the founders events, we always got that kind of feedback because you could ask honest questions and get good feedback from people that the investors were investing in. But you also got networking opportunities because they would make introductions. Even if the investors are in California and we're in North Carolina, we always were able to get a good list of introductions because the investors want to know that you're known by other people, and then they can also do a little more due diligence. So it kind of goes both ways. But that's a great way if you can network somewhere where there's a community.
Yeah. I think many folks here probably are in the large area, some California and or areas that are investors. There's a few that are from like Alaska, Hawaii, very small networks. But generally what I've learned over time is that the innovation centers or the small business development centers tend to then attract that region's angel groups, which are small, right? You're always belly aching about that, but that's a start to then network into these regions' investor networks, and to then try to get feedback. Usually the innovation centers probably get a lot of information back from the different companies that go through them. So that might be a way to get some more information in this opaque world. Let's see. There's Vidar has three questions I'm going to ask all 3. Are there any book or course about pitching? How can we find investors worldwide? And there's a lot of gut feelings. Is there any software site to help measure or map some of these gut feelings? Anybody want to take those?
Mike, you want to start?
Sure. So I don't know about any book around pitching, but I do know that Y Combinator has this thing called Startup School, which I think is free, and I think anybody can do it now. And a lot of the curriculum is online, which does a really good job of conveying just what the norms are in pitching. Like there's a certain format for a pitch deck if you're pitching to somebody who's invested in startups before. And if you deviate too much from that general structure, it ends up being a red flag for better or worse. So looking through the Startup School materials can be really helpful. And I'll find a link and post it in here somewhere. The other thing that I'd like to comment on is due to we're a global business, how can we find investors worldwide? I don't have a ton of experience taking money from investors outside the US. We've talked to a couple of European funds, but I do know that the way that angel investors invest in startups in the US, if you think about it, is really weird, right? Like I was raising money for MedCrypt, the very first round of funding, talked to a co-founder or talked to a founder of some other company in our space that I was friendly with. And I said, hey, we're stuck at $450,000. We're trying to raise 650. We need another 200. And he's like, oh, there's this guy you should talk to. His name's Chen Fang. He's a professor of radiology at the University of Calgary, I think in Alberta. He had started some imaging company before and made some money. He invested in my company. You should talk to him. I talked to the guy for 15 minutes and he's like, all right, sounds good. Send me the wire info. I'm like, oh, okay. How much are you in for? He's like 100,000. I'm like, oh, okay. I've never spoken to Chen again. I maybe talked to him once after that. He wired us $100,000 the next day. And like, he's been helpful when we've needed him to be helpful, but that's really unusual, right? And
That's an exception. Yeah.
But any form of angel investing is just a lesser degree of that, right? Because you think about it, you say, okay, I've never started a company before. I'm an engineer. I have a good idea. There's a 90% chance that my business is going to fail and it's going to go to zero, but there's a 10% chance it could be really big. Do you want to put some money in? Sure. Here's enough money to go buy an entry-level BMW. Go invest this in your company. It's a very uniquely, originally it was a uniquely Silicon Valley sort of thing. And I think it almost requires investors who have benefited from that community in the same way earlier in their career. If I have a big exit here, I'm hoping to be able to write angel checks in startups in the future. And if it doesn't work out, not a huge deal because there were investors who took a bet on me as well. I'm not sure to what degree that same attitude or culture exists in areas outside the US. I know that companies try to foster it. And there are venture funds in Europe for sure. There's venture funds all over. But getting back to the idea that if your investors deviate from the best practices too much, it's a bit of a red flag. I don't know what it looks like to raise money for a company outside the US. You might almost be better coming to the US. I don't know.
Yeah, I worked with a Norwegian software company that raised money from all over Europe. And I would say the investors were very similar to US. And they acted pretty well, but that was some time ago. I don't know that there's one network you could go to. You really, again, it was networking and getting to know these investors and where they are and looking at portfolio companies that had gotten investments elsewhere. And you can start to look at who made those investments and maybe reach out to them. So that would be maybe one way to look at it. But I will say too, I was working with a young woman on her pitch deck, and it was a very sophisticated technology. And she had a Swiss company very interested in investing, and it got down to the end. But Mike brought up that when they got the term sheet, it was very vague. It was unsettlingly vague. So we went back to ask questions, but we could never get the real clear answers. I think it's just one of those things when you're long distance, it might be harder to get clarity and transparency that you need on these deals. So just be cautious, but the money's out there. There's a lot of money all over the world. I think, start at home. And again, if you start at home, some of the investors that you might be talking to have those relationships globally.
I'm hoping so. I mean, I feel like when I started getting into the kind of the angel investment business, it really very much was a peer-driven type of activity. Yes. And I think with, company building is very similar. And so you end up getting intelligence from your peer groups.
Yeah, I think very much so. And to the point of pitching, there's a lot of online resources. I mean, we help companies all the time. We do something called deal desks, and that we sit down and spend time just going through their pitches and honing and giving good feedback and trying to cater the deck to what we know investors are going to be looking for. But there's certainly a lot of online resources and templates that can help you with the pitch deck. And don't forget, you are telling a story. One of the sessions I was in last week, the reason why someone was starting the business came forward 1 out of 10. And
Mhm.
we were more engaged because the story that he told was why he's doing it. And you could feel the passion for that thing. And I know this is, in the space that you're in for NASA and the things that are highly technical, you still want to tell that story. It's important. Are you doing it for societal reasons? Are you doing, what's your personal drive? That story into your pitch deck, which is really all the data points, is, I think, will help you carry your message forward and sell your ideas.
Yeah, absolutely. That emotional connection is a must. We're all people. You need to make
Yeah.
that emotional connection. As technologists and engineers, sometimes hard. Got to do it though. I guess, Mike, it looks like you're thinking about something. Any additional comments around what we're saying?
The storytelling part is something that definitely resonates with me, right? So storytellers tend to be able to raise money more easily than non-storytellers, almost to a bad extent, right? If you think of whatever the horrible stories in the news are of founders doing bad things, nothing else, they were great storytellers.
Yeah, exactly.
And I think the thing that allowed me to raise more money or raise money more easily than I would have otherwise is my grandmother, with whom I had a very close relationship, was, for lack of a better term, just an excellent bullshitter. Just, oh my God, the stories she would tell were just amazing. And I remember being a 10-year-old kid, and she had some story about getting run over by a truck once. I had no idea if it was correct. This is out there. But she had a really interesting way of framing stories that made things really memorable. And anytime that I've raised money, I've talked about, the story of what we're doing. Like, here's how the medical device industry got to the point where we have devices keeping patients alive that a 10-year-old could hack if they wanted to. Is that an okay situation? I don't think so. Here are other analogous industries and how cybersecurity has evolved in those industries. How do we all think the healthcare industry is going to deal with this over the next 10 years? Are we going to status quo okay, or are we going to change things? And being able to craft a good story is what has gotten people to invest in the company. So if I had to choose between being the best engineer in the world or being a pretty good engineer and a great storyteller, the second is a powerful combination.
I know, anathema to some folks, but it's important. How do we actually kind of? There's so much creativity in technology, right? In creating and engineering, and it's like you just have to kind of put a different twist on it, a different lens on it, and the passion that everyone is driven by should come out. Here's a question: suppose we decide that there are too many red flags for a particular investor, and yet you've been talking to them. Any suggestions on how to politely decline? That presumes they want to come and invest in you.
Well, I mean, it's just, you can always say, we're oversubscribed, or we're getting, we have a lot of interest, and just, we're trying to align with our investors. Just be upfront. They expect it. They may want you even more because you're turning them down.
That is absolutely true, right? Nothing, and maybe we'll get to that in my closing thought here, but nothing makes an investor want to invest more than you saying, "Nah, we're going to take somebody else's money." Like, wait, what? Yeah. So that's the real thing. But investors spend 99% of their communications turning startup founders down. And it's not uncommon for investors to be on the other side of the same communication. So it's probably not as big a deal as you think it is. Saying to somebody like, "Hey, I really appreciate the time you put into looking at the company. We decided we're going to go with another fund that we think better aligns with our vision for the company that we want to build. We'd love to stay in touch as we build the company and see if maybe there's an opportunity to work again in the future." I think that's all you really need to do.
Yeah, it could be this stage or whatever that a company is in, right? An investor might not be appropriate for the stage that you're in, and there's a variety of other reasons. I think going back to the maybe the diligencing side, and what have been, I guess, Mike, you talked a little bit about the crazy investor example. I guess on the flip side, do investors kind of get their reputation out there by being a good investor, and do founders then go find those investors? Does it work that way too?
Absolutely. Yeah, I mean, so venture capital investors, or even seed investors, anybody who's investing money on behalf of somebody else, they need to convince investors to give them money the same way that you're convincing investors to give you money. And one of the things that professional investors need to do is convince their work on limited partners, their LPs, that they have better deal flow, right? I'm going to see better companies earlier, and that's how I'm going to beat all of the other VCs that you could otherwise be investing in. Having really bad reputations with founders is a terrible way to have good deal flow. So, having investors know that, word gets around. Their portfolio companies talk to other founders. So in general, they try to be on best behavior, which is why, if you really do see red flags or you hear negative stories, it's even a bigger deal than you might think it is, because investors should know that founders talk, other investors talk. This is a really small community.
Yeah, and I would say, and we're kind of fortunate in RGP, and I know in California, the investors that are my colleagues, we do events. I mean, we bring early founders in, we try to help educate and try to give them feedback. And, we work with universities because faculty are also inventing. And so we bring in lots of different parties and work together. And some of the best investors I found are mentoring investors, and they really want to be known because they want early in, and they do want that pipeline. But they're good. They're good. There are a lot of good ones that are investing in the effort of finding really great deals.
I have to say that the reputations of investors do get out there. Locally here in San Diego, there was a group called Tech Coast Angels. They're now called New Fund. They have all kinds of good and bad reputation. They were reputed to not do any investing whatsoever. A bunch of, retired folks just shooting the breeze all the time. And it took, I think, one of the new executive directors to really turn that around. It took several years, right, to do outreach into the community, convincing founders that we're open for business. And so it does go both ways, and you just need to kind of get yourself out there into the right circles. Yeah. We have a little bit of time left. I wanted to start talking about a framework, maybe, from a diligencing perspective. From an investor's perspective, there's a diligencing framework in looking at companies. I mean, from a company's perspective, is there a framework that one could apply, and how would you think about it? Maybe, I don't know who wants to go first.
I mean, I'm more maybe a simple framework, but I'm initially making a list by doing some real heavy research on investors that might be interested in the specific domain area I'm building, and I'm then working to outreach and network with them before I'm ready to present anything. And I take generally in there, one or two of them will be maybe more interested in being somewhat mentoring and starting to make referrals to get me networked with more investors. And then when I'm ready with my presentation and I feel confident that I've got all the details because I've done some homework with them, I've had discussions, then I start putting on the calendar invitations to go try to present my startup with them. And then it's a matter of keeping a spreadsheet or Salesforce or whatever you do, but keeping tabs on everything that you've done and who you've done it with and who they're networked with. If you've got a larger investor and you want to look and see who they've invested with and who they've invested in. So that homework up front is really very much helpful. That sets the groundwork for me. It's kind of a playbook, if you will. So I don't know if that helps. I'm not giving you specific steps. Mike probably has a much more formal way of going at it.
It's basically just, does this investor invest in the type of business that I'm running, to your point, Teresa? Number two, do they want to build the same kind of business I do, right? Are they looking for, is it an angel investor that would be very happy if we sold for $10 million early on? Yeah. Or is this somebody who wants to put in 10 years and build $1 billion business? How is this behavior going? How is this investor going to behave when things get tough, right? And then last, and I think the least important is, can this investor do anything to help me other than give me their money? Yeah. And that's very much sort of a bonus at the end, right? Because some of our best investors are people who have supported us financially when we've needed it, and they'll take a call if I need to, but they're not calling me every 2 minutes. I've got other people who call me every 2 minutes, metaphorically, and that's offering a little more help than maybe we need, right? So it's you got to find somebody who wants to strike the right balance. And that actually gets to one of the red flags for me that you might see early on. If you see an investor say, hey, I'd love to invest, but as part of investing, you have to give me a bunch of additional advisor shares. I don't know why this is something that I see this happen. I've heard this happen. I've had people say it to me. It's just another example of one of those things where you're like, okay, it's a little out of the ordinary. Maybe there's a valid reason for that. In most cases, there isn't.
Yeah, totally agree. One thing I would say too is when you have these, you might have all this great network and you're starting to talk to investors. The thing I see most missing in investor presentations is the use of funds. How much are you asking for? And what are you going to use that money for and why? What's it going to get you to? So just a FYI, that's something I've seen missing in the more frequent or the more presentations I've seen over the last few weeks. And it's kind of surprising because it's one of the most important things you need in there.
Interesting. So Mike, earlier we were talking about, you mentioned advisor share bad behavior and also what to look out for in either accelerators or maybe now these VC platforms, I think is the new term for some of them, like Andreessen has one. Any comments there that you can offer?
Yes. So, I think about one of the first people to, well, one of the investors in our first round, including Ellen, was a guy named Gary Kurtzman, who was a professor of mine at the University of Pennsylvania, a really great guy. He invested through a fund he was working for at the time. And as soon as he invested, anytime I have a problem, I can pick up the phone and call Gary. He's going to help me problem solve through it, right? He's on our team and wants us to succeed. Ellen and your partner, Doug, our company hit a rough spot 2 years ago. I believe it was Doug. I'm like, hey, here's the problem. Doug's like, I'll be at your house tomorrow. We'll figure this out. And we figured it out. So you want investors who are willing to say, hey, I'm going to put in money and I'm going to help do the work. Anybody who's saying, hey, I want to be paid in equity for assistance that I'm giving, you need to be very certain that the assistance is worth it. We had an advisory board very early on in the life of our company, and we were able to get a guy who used to run the imaging business at Siemens on the advisory board. After the first 6 months, he didn't really do anything, but that was fine because when we were raising money, we were able to say, hey, here's our idea, and it's credible because this guy who used to run this business at Siemens says it's credible. That's really good. That's really good value. I've had other accelerators that we've applied to at various points in our existence say, hey, we're going to invest $200,000 in your company. Awesome. But it's in the form of assistance, and it's legal assistance, and it's our advising, and it's access to our network. And I'm like, I can't pay engineers with $200,000 of assistance. So either get in here and write code, get me a customer, or I need cash. Those are the only three things that I need, right? So anytime an accelerator is saying, hey, we're going to take equity and we're going to make an investment in your business, but the investment isn't dollars, it's the assistance we're providing, I wouldn't categorically say that that's bad behavior, but you got to be really certain that the assistance they're giving you is in fact worth the face value of the investment.
Yeah.
So
just to your point, I wanted to bring out that because there was a couple of accelerators that I knew of, and you compete and then you win, and maybe your stipend is $35,000. Well, it costs $35,000 to go through the accelerator, which is promised to get you to these stages of commercialization and market opportunity. Yeah. And we've seen very little success with that. And so I think, again, just do the due diligence. It's not always the best thing.
Yeah. Conversely, Y Combinator, which we were fortunate enough to go through, I think when we did it, it was $150,000 in cash via a safe. But you can read about what that is. One of the links that was posted. And then you go and pitch at demo day, and the median YC company raises $2 million at a 10 million pre or something, at a 10 million cap when we went through it. So in that case, the $150,000 for 7% of the company was a lower valuation than at which we had raised previously. But we did the math and said, hey, I think the exposure at demo day and the credibility this is going to give the company is going to make it worthwhile. And in retrospect, totally worth it. It was the best thing we did. 7% was a deal. It would have done 7.5%. But we got $150K in cash, and that was much more than what it cost us to participate in the program. But on the flip side, there are other accelerators that I've seen that are very industry specific, and I suspect that H4X is one, where it's dollars that have come from bigger players in the industry, and they're saying, we're not taking equity, we just want to be here to help, and we'll make some intros to companies because the big companies who fund our program need innovative thinkers to give us ideas. Those are great too. But it's when somebody says, hey, I'm making a $200,000 investment in the form of advice, that's a red flag.
Yeah, there are a few out there. One last question, and then we'll probably get off the stage, just a few minutes left. How do you create traction for investors at the really early stage? What kind of, what are the metrics, KPIs?
For the
investors, like what would investors want to hear?
Oh,
You're like a pre-seed stage company.
well, they want to, you're putting a milestone plan together. Is your next stage to get a product out the door? Then your feedback and your KPI is the diligence on where you are in that development stage, and is it going to hit the time frame that you said you were going to get that product out the door? Is it going to cost you more money to get it out the door than you anticipated? Are you on track with the funding for getting the product out the door? I mean, those milestones that you're setting and you're sharing with them, is it revenue? Are you have sales lined up and they're not coming in, so you're missing those KPIs? Is it, so is it sales related, partnership related? You really go back and look at what you're telling them you are going to do that gave them the confidence to give you the money, and you put a timeline together on when you were going to do it. Those are your KPIs. Are you doing it? Financials, you've got to stay really solid on the financials. If you're in pre-revenue, it's what are you spending? What's your burn rate? Are you keeping it steady? Are you meeting the deadlines with the development teams that you have? Mike, is that pretty much your experience?
Exactly right. I mean, I tend to think of MedCrypt as an experiment that I'm 8 years into or whatever. And an experiment has hypotheses, right? We had 2 hypotheses. One is that medical device security was a real problem, and we would see evidence of that. And the second is that medical device manufacturers would need help with that. And we laid out a plan of, here are 5 milestones of how we think the business matures, right? It's going to be slow at first. Eventually, FDA will do something and it'll get faster. Each of those milestones, we had sub milestones. So there's nothing more powerful than going to an investor and saying, hey, we talked 6 months ago. I said, here are the 3 things that we need to be able to demonstrate in order to de-risk the business and to prove one of our core hypotheses. And we just proved 2 of the 3. And that's why we've de-risked the business. So, what those specific metrics are, what the specific milestones are, really depends upon what your business is. If you're selling SaaS accounting software, you probably want revenue pretty early. If you're a pharmaceutical startup, you're probably never going to have revenue. If you're successful, Merck's going to buy you, right? If you're sending stuff into outer space, I don't even know how that works, but you have to demonstrate that you understand how a business would evolve if it were successful, and how to prove that it's working, or detect if it's not.
Yeah. And sometimes your traction is just even being able to say that you have an early investor, depending on where you are, right? The fact that you actually, like if you're a Series A VC, you're going to probably make sure that the company is able to raise their pre-seed and seed round. And if you're a pre-seed VC, you're going to want to know that they've been able to get money from angels. It's not like, oh, I'm just going to run off to a Series A investor and raise money. It doesn't work that way. So there's that kind of traction as well.
Right. And even in, I think I'm seeing, and you might have mentioned this too, Alan, in the SBIRs, they want a commercialization plan. They want to know how you're going to market in the early stages, because they want to see the success of the money helping you get to those stages. So I'm seeing them ask for milestone charts and more in the SBIR than they used to in the first phase.
Yep. Well, thank you so very much to both of you. We're at time. We're at 1 o'clock. Don't want to overstay our welcome. For the audience here, we'll provide our notes and our recording out to you. We have a YouTube channel that we're uploading to. And again, I hope to see everyone out there. And Mike and Teresa, again, thank you so very much. Really appreciate your time.
Great to be here.
I'm happy to help if anybody has questions, and I'm shooting my email in the chat here.
Wow.
Same here.
Thank you for that. Thank you.
All right.
All right. Thanks, everyone.
Bye.
Thank you, everyone.